Welcome to our deep dive on custodial investment accounts, also known as UGMA and UTMA. Today we will unpack why these accounts, while popular, can create hidden risks for families if misunderstood. We will explore ownership and control, the sudden control cliff at age 18 or 21, tax pitfalls like the lack of a step-up in basis, and smarter strategies to protect your child and your wealth. Let's begin by outlining what we will cover, so you can follow along step by step. First, we will define UGMA and UTMA accounts in plain language. Next, we will highlight the sudden transfer of control, known as the control cliff. Then, we will contrast legal ownership with day-to-day control. After that, we will examine key tax issues, including basis carryover, capital gains, and the absence of a step-up in basis. We will then compare pros and cons and review alternative approaches. Afterwards, we will walk through a practical parent preparation checklist for children. We will also analyze a quick case study to bring the numbers to life. Finally, we will summarize key takeaways and provide next steps. Before we proceed, please note this presentation is for educational purposes only and does not constitute financial, legal, or tax advice. Everyone's circumstances are unique, so consult a qualified fiduciary, financial planner, attorney, or tax professional before making decisions. With that important disclaimer in place, let's move into the basics of custodial accounts. To start, a custodial account under UGMA or UTMA is a way to transfer assets to a minor. The donor, often a parent, makes an irrevocable gift to the child. A custodian, often the same parent, manages the account on the child's behalf until a specified age. The key point is that ownership transfers immediately at the time of the gift. The child is the legal owner from day one, even though the custodian controls the account's management until the age of majority set by state law. At that age, the child gains full legal control and can spend or invest the funds without parental consent. Now observe the timeline. At birth or early childhood, gifts start flowing into the account. By age 13, balances often grow, and it's a good time to introduce basic financial lessons. Around age 16, many teens want big-ticket items like a car, and this is an ideal moment to focus on budgeting and trade-offs. At age 18 or 21, depending on state law, the control cliff occurs. At that moment, full legal control transfers to the child, and the parent's authority ends. By age 25 and beyond, outcomes tend to diverge. One path is a disciplined investor who grows wealth, and the other is rapid spend down when education and boundaries were insufficient. Next, it is important to separate ownership from control. Ownership rests with the child starting the instant the assets are placed into the custodial account. Control, however, is exercised by the custodian only until the age of majority specified by state law. If the custodian dies, the assets do not revert to the parent's estate because the child is the owner. Instead, a replacement custodian is appointed. Once the child takes control at age 18 or 21, the parent cannot legally direct how the funds are used and has no veto power. Now we turn to taxes. While the child does not trigger gift tax upon receiving the transfer, custodial accounts do not provide the inheritance advantage of a step-up in basis. Instead, the child inherits the original purchase price, called carryover basis. When the assets are eventually sold, capital gains tax is calculated as the sale price minus that original basis. This can result in significant taxes after decades of growth. In contrast, when assets pass through inheritance, heirs typically receive a step-up in basis to the market value at the date of death, potentially eliminating much or all capital gains. Therefore, passing appreciated assets via inheritance can be more tax efficient than using a custodial account. Let's compare options. In a UGMA or UTMA, the child is the immediate owner. Control rests with the custodian only until age 18 or 21. The capital gains basis is carryover, meaning there is no step-up. Funds can be used for the child's benefit broadly, but they can weigh heavily against financial aid because they are the child's asset. Inheritance via a will or trust typically provides a step-up in basis for appreciated assets, subject to local laws and specifics. A 529 plan is owned by the parent or other owner, with the child as beneficiary. It generally carries favorable financial aid treatment and tax advantages when used for qualified education expenses. Lastly, a revocable living trust allows the grantor to maintain control during life and can support step-up at death depending on asset titling and jurisdiction. Flexibility depends on proper drafting and goals. On the plus side, custodial accounts are a straightforward way to transfer assets early, and with proper guidance they can teach investing and responsibility. They also allow broad spending for the child's benefit before the control age. On the downside, the gift is irrevocable, and ownership belongs to the child immediately. The control cliff at age 18 or 21 removes parental veto power. The absence of a step-up in basis can lead to substantial capital gains taxes. Finally, these accounts often count more heavily against financial aid, compared with assets held in a parent's name. Moving forward, there are smarter ways to balance generosity with control and tax efficiency. Consider retaining highly appreciated assets for inheritance, which may allow a step-up in basis. For education goals, prioritize a 529 plan that offers tax advantages for qualified expenses. For non-education goals or more customized control, evaluate a revocable living trust or a testamentary trust with staged distributions. If a UTMA already exists, you can convert to a UTMA 529 to earmark for education. But remember, the funds remain the child's property. When gifting to a UTMA, consider using cash or low-gain assets, while keeping high-gain positions outside the account to limit future tax exposure. Most importantly, begin financial literacy education well before the control age and coordinate decisions with professional advisors. Additionally, prepare your child deliberately before the control cliff. Start with basic money conversations around ages 10 to 12. Review account statements together monthly, explaining gains, losses, and costs. Establish shared goals such as an emergency fund, education expenses, or a first car. Write a simple spending policy that differentiates needs from wants, using concrete examples. Practice decision-making through mini-budgets and simulated purchases. Consider matching contributions to encourage saving and investing. As your child matures, gradually hand off more decision-making authority between ages 16 and 18. Finally, agree in advance on a concrete plan for the first 90 days after legal control transfers. Quiz time. The question is, when does your child truly own assets placed into a UGMA or UTMA account? Option 1. The moment assets are deposited into the custodial account. Option 2. At age 18 or 21 when they gain control. Option 3. After college graduation. Option 4. Once the account exceeds $15,000. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is, the moment assets are deposited into the custodial account. Ownership is immediate upon gifting. Control transitions later at age 18 or 21, but legal ownership belongs to the child from the start. Second quiz. What happens to the cost basis of assets held in a custodial account when the child sells them? Option 1. It steps up to the current market value at sale. Option 2. It carries over from the original purchase price with no step-up. Option 3. It resets annually based on inflation. Option 4. It disappears entirely. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that the basis carries over from the original purchase price, meaning there is no step-up. In contrast, assets received by inheritance typically receive a step-up in basis, subject to the specific circumstances and laws. To illustrate, imagine you gifted $10,000 in a stock to a UTMA when your child was 5. By age 21, the position grows to $80,000. The capital gain is $70,000, which is calculated as $80,000 minus the original basis of $10,000. If the child sells at that time, they owe capital gains tax on the $70,000 of appreciation, subject to their tax bracket and rules like the kiddie tax. If the asset instead passed at death via inheritance valued at $80,000, a step-up in basis could allow a sale with little to no capital gains tax, depending on the situation. The takeaway is that account structure and timing can materially alter taxes, while education determines whether the funds are used wisely. To recap the essentials, ownership transfers to the child immediately, even while a custodian manages the account. The control cliff at age 18 or 21 eliminates parental veto power. Custodial gifts do not receive a step-up in basis. carryover basis applies, which can increase taxes on appreciated assets. In contrast, inheritance can provide a step up in basis and potentially greater tax efficiency. If a custodian dies, the assets remain the child's property, and a new custodian must be appointed. Finally, educating your child before the control date is critical to avoid poor outcomes. In summary, UGMA and UTMA accounts can be useful tools, but they are unforgiving when misunderstood. Consider carefully whether to gift now or pass assets through inheritance for better tax outcomes. Use 529 plans and trusts, where appropriate, to match control to your goals. Start financial education early and create a clear plan for handing off control. Finally, consult qualified professionals to tailor these strategies to your family's needs and state laws. Before we close, if you found this valuable, please like the video, share it with another parent who might benefit, and subscribe for more clear, actionable finance content. Tell us in the comments how you plan to prepare for or navigate the control cliff, and what topics you want next.